relying on a single, isolated financial engine to navigate a highly volatile and complex macroeconomic landscape in 2026 is a critical structural failure deployed by the vast majority of retail portfolios. When you concentrate your hard-earned net worth exclusively into high-yield covered call options syndicates, you capture immediate monthly cash flow but systematically surrender downstream equity growth, pricing momentum, and long-term capital appreciation. Conversely, if you lock your primary investment capital into traditional market capitalization-weighted index trackers, you lock in long-term corporate earnings compounding but effectively freeze your immediate household liquidity due to microscopic distribution yields that rarely outpace real-world inflation. To bypass this friction completely and unlock a multi-phase distribution cycle, institutional wealth management architecture utilizes what is known as the dynamic quad-engine allocation framework. This advanced strategic setup divides your total capital footprint into 4 distinct, mathematically balanced operational pillars, intentionally designed to eliminate the historical compromises of income investing. We are talking about combining pure equity growth leverage, continuous dividend compounding speed, low beta cash flow protection, and technology sector equity harvest overlay mechanics into a single, self-clearing brokerage operation that executes completely on autopilot. By building this 4-tier structural matrix, you systematically eliminate cash drag, the phenomenon where idle cash balances sit unproductive in a settlement account while keeping your core principal value protected from massive, sudden secular market drawdowns. The mathematical reality behind this multi-layered diversification blueprint is absolute capital optimization. You no longer have to make a painful compromise between surviving a sudden macro market contraction and aggressively growing your generational net worth over a multi-decade horizon. Traditional financial theory tells retail investors that they must sacrifice growth if they want yield, forcing a binary choice that limits wealth accumulation. The quad-engine paradigm shatters this legacy model by treating yield and growth not as competing goals, but as synchronous, interlocking components of a unified liquidity flywheel. When one engine encounters headwinds due to shifting monetary policy or rotating sector valuations, the adjacent engines generate immediate mechanical compensation. This ensures that the total operational momentum of the portfolio never drops below its baseline efficiency threshold. To successfully build this high-velocity framework inside a live trading account, an investor must completely abandon emotional biases, stop chasing speculative single-stock yield traps, and rely strictly on the cold, hard data models that govern institutional asset management. Let us look closely at the exact ticker metrics, historical behavior, patterns, and structural weighting strategies required to establish this unbreakable passive machine. Let's perform an exhaustive, deep dive data audit on the 4 specific institutional vehicles backing this structural matrix. Our first foundational pillar is the Vanguard S&P 500 ETF, serving as our primary uppercase capital appreciation engine, holding 500 of the largest, most fundamentally sound and liquid corporations in the United States. This vehicle locks in unlimited upward market breakout capture, anchoring the portfolio directly into the compound earnings power of global corporate leaders. VOO provides the baseline structural equity layer that ensures your principal does not decay over time under the weight of inflation. Our second pillar transitions into dividend health with the Schwab US Dividend Equity ETF. SCHD does not blindly chase high yields. Instead, its algorithmic screening protocol filters corporate balance sheets for fundamental cash flow health, low debt-to-equity ratios, return on equity, and a minimum of 10 consecutive years of verified dividend growth. This acts as our long-term compound multiplier, continuously increasing our underlying yield on cost through every business cycle. Our third pillar shifts directly into immediate high-frequency monthly income generation using the JP Morgan Equity Premium Income ETF. JEPI does not operate like a standard passive index fund. Its institutional managers maintain a defensive, low-beta subset of S&P 500 stocks while layering equity-linked notes, or ELNS, directly over the asset structure. These specialized instruments sell out-of-the-money call options on a rolling basis, effectively converting intraday stock market volatility into immediate, liquid cash distributions. Finally, we maximize our monthly income velocity and capture technology sector premium spikes with our fourth pillar, the JP Morgan Nasdaq Equity Premium Income ETF JEPQ. JEPQ utilizes a matching institutional covered call overlay strategy but applies it specifically to the tech-heavy, high-volatility listings of the NASDAQ 100 index. Because technology equities naturally display higher levels of implied volatility, the options premiums generated inside JEPQ are significantly higher, providing a massive yield booster that expands aggressively during tech sector corrections. By structuring these four powerhouse vehicles into a highly coordinated, single brokerage framework, your capital functions as an unbreakable financial fortress. We handles long-term capital expansion. SCHD guarantees consistent dividend growth. JEPI stabilizes the portfolio with low beta monthly cash. And JEPQ supercharges the immediate monthly distribution stream. This precise alignment covers the structural blind spots of every individual asset class, ensuring your net worth expands during standard bull runs while an automated, high-volume stream of monthly dividends clears into your account when the broader markets trend sideways or grind through intense macroeconomic uncertainty. Let's break down the exact distribution mathematics, capital allocation ratios, and cash flow simulations required to operate this quad system at absolute peak efficiency. To optimize for both long-term growth and immediate monthly cash flow preservation, we implement a strict 40-40-10-10 operational ratio layout. For a baseline investment of $100,000, you deploy exactly $40,000 into VOO for baseline equity growth, $40,000 into SCHD for dividend growth compounding, $10,000 into JEPI for low beta defensive S&P 500 premium capture, and $10,000 into JEPQ to unlock high-yield technology sector volatility harvest cycles. The total blended expense ratio of this entire multi-tiered strategy sits at an incredibly competitive point of approximately 13 basis points. This means over 99.87% of your total compounding energy remains completely inside your own brokerage account rather than being siphoned away by the predatory fee structures of standard active retail wealth advisors or mutual fund managers. On a blended distribution scale, this specific allocation setup generates a highly reliable annual yield averaging between 5.5 and 6.8%. Dynamically swinging based on macro market volatility and the prevailing CBOE volatility index, or -1 levels. For a $100,000 deployment, this translates into an automated annual cash flow stream of roughly $6,000, landing straight into your account as a completely hands-free monthly paycheck of $500. Is scaled proportionally to a larger portfolio milestone. The numbers expand linearly while the structural risk remains perfectly contained. This mathematical framework fundamentally alters your wealth velocity because you are generating a predictable, immediate income stream while maintaining a massive 80% of your total portfolio weight in high-growth, uncapped equity positions. The immediate cash flow from JEPI and JEPQ provides behavioral comfort, removing the panic that retail investors usually feel during a market downturn, while the growth engines of VOO and SCHD ensure that your purchasing power doubles and triples over a multi-year investment horizon. It is a highly calibrated, self-funding capital loop designed to maximize efficiency across all market regimes. The ultimate terminal velocity of this quad-engine architecture is achieved when you implement our strict mechanical rebalancing protocol alongside an automated fractional share dividend reinvestment sweep. Every quarter, you must audit the individual asset weight expansions across your four distinct engines. If an aggressive technology rally or an extended growth cycle pushes your VOO or JEPQ allocations past their designated percentage thresholds, you systematically harvest those unrealized capital gains and reallocate that equity directly into SCHD or JEPI to permanently secure a higher baseline of recurring monthly cash distributions. Conversely, during a sudden, violent market liquidation event when broader equity prices plummet, you draw down directly from the heavy monthly cash distributions generated by JEPI and JEPQ to purchase heavily discounted shares of VOO and SCHD at historical market bottoms. This system creates a continuous, automated buy low, sell high loop that executes completely devoid of human emotion or psychological hesitation. You are effectively using market panic to fund your long-term growth engine for free. Institutional compliance disclaimer: all fund statistics, tickers, models, and performance simulations outlined inside this presentation are strictly engineered for advanced analytical and educational purposes only. past performance metrics across broad market equity trusts, dividend growth funds, and institutional options overlay instruments do not guarantee future distribution consistency, payout levels, or principal safety. Covered call mechanisms carry natural upside limitations during parabolic market breakout expansions, and all asset allocations carry inherent market volatility risks. Consult a certified financial professional and assess your individual tax bracket liabilities before executing heavy capital allocations inside your live accounts. If you are ready to completely abandon legacy retail investing models, stop choosing between immediate cash flow and future capital growth, and want to engineer a high-velocity dual-purpose financial machine in 2026, drop a comment right now with your personal monthly passive income target. Hit that subscribe button immediately to lock in our upcoming corporate data models and deep institutional portfolios. Stay disciplined, protect your principal capital, and always track the data structures.